On our radar this morning is Post Malaysia, which closed yesterday at 88 cents. Hong Leong Investments Bank attended the group's briefing earlier this week. It is keeping its whole call on the counter, but it's cutting its target price to 87 cents from 93 cents. Here's why. HLIB expects Post Malaysia to register a loss of 70.7 million ringgit in FY21 after inputting weaker postal services and aviation segments. To recap, Post Malaysia recorded its largest quarterly net loss of 232.35 million ringgit in the fourth quarter of FY20, with revenue sliding 12% quarter on quarter. According to HLIB, management expects the entire group, including its postal segment, to break even in FY21. But the research house believes this could prove to be an uphill task. It says the 20% growth in courier volumes that Post Malaysia is eyeing seems to be a relatively high target. This is considering that FY20 was an abnormal year, driven by extraordinary volume surge due to COVID-19-linked lockdowns. HLIB says it does believe FY21 courier volumes will be higher than pre-pandemic levels, driven by the new normal of shopping trends. But volumes will not mirror that seen in the second and third quarters of last year, as MCO 2.0 was not as restrictive as its first iteration. In addition, HLIB says the aviation segment will continue to be hampered by COVID-19 headwinds, as recovery was slower than expected. The research house is, however, keeping its FY22 earnings forecast on the group at 16.1 million ringgit and EPS at 2.1 cents. So what's the consensus? According to the latest Bloomberg data, there are 2 buys and 3 holds. Average target price 1 ringgit and 8 cents versus the stock's last close of 88 cents.